Good afternoon and welcome to today's Director's Cut. We'll get started with Director Lynn Helms.
Thank you, Bethany, and thanks everyone for tuning in. It's great to be with you on a nice rainy May afternoon. We are going to go back in time and look at the month of March. Our production numbers lag by a couple of months to allow accurate data collection and reporting. So we're looking back to the month of March across the state of North Dakota. I think we should take note that March was a pretty stable month in terms of weather. Had a big, I think, a snow event on the first day and one on the last day of March. But in between, it was just cold, well below normal temperatures, which can restrict or reduce hydraulic fracturing, but is not bad for movement of people and materials in terms of drilling and production. So kind of a mixed bag. Oil production down just slightly, a 3% decline. By contrast, New Mexico, which doesn't experience what we do in March, had a 3% incline or increase in production. We had a slight downturn in oil production of 3%. Natural gas production held pretty much constant. It's way out like in the third decimal place in terms of the change in natural gas production, which does mean that the gas oil ratio began to pick up again. And so we saw about a 4% increase in gas oil ratio. Too early to say what that long-term trend is going to be, but I think Justin's going to have some information to share about why we've been seeing a flattening, a temporary flattening or decline in gas oil ratio. We don't think that that's a long-term trend, but perhaps over the next year or two, as drilling with 3 and now 4 mile laterals moves out away from the core area into tier 2 and tier 3 areas, we should see that gas oil ratio grow at a slower pace. Oil production, like I said, interesting, it was down about 36,000 barrels a day, even though our active well count was up 141, and natural gas production held flat, which meant the gas oil ratio increased about 100 cubic foot per barrel. We experienced just recently a pretty significant drop in drilling rig count, going from the mid to lower 40s down to below 40. We're at 39 today, and that's because road restrictions went on, and that's another phenomenon that we have in North Dakota that's kind of unique to this part of the world. During the winter months, like we talked about, March being extremely cold, we get frozen ground down at, as deep as 6 feet. The top 6 feet of the earth freezes, and then that thaws out in April and early May, and the roads become so soft that load restrictions are placed on. And so I was just up in northwestern North Dakota earlier this week. I saw that the trucks that would normally be hauling 2 boxes of frac sand were hauling 1. And but now we're beginning to see those road restrictions come off, so we should see activity pick back up. People are slow or hesitant to move drilling rigs, frac crews, frac water, frac sand when those road restrictions are on. But that should be behind us now, and we should start to see we should see the drilling rig count return to normal, mid to upper 40s, and then grow slowly from there. Talked about the weather. Completions in March were down significantly from February and again down in April. That has to do with weather and road restrictions. Interestingly enough, activity on Fort Berthold, particularly in the drilling area, has picked up substantially, with 7 rigs running there versus 4 in a month ago. And so we are seeing increasing activity there. Like I said, frac crews are down 2 from last month. On the national front, natural gas prices still extremely low, and they're the lowest that they've been since the third quarter of 2020, which was right in the COVID pandemic. So really interesting phenomenon there, because we saw such a sharp spike last fall and last winter, as Europe was starving for natural gas, and we saw prices really climb. Oil storage in the United States, outside of the Strategic Petroleum Reserve, is at a normal level as it is worldwide, and so a little bit of softening in prices as we try to figure out whether the U.S. is going to exceed its reach its borrowing limit, and what's going to happen there with worldwide economies. But oil storage pretty much normal except for the U.S. Strategic Petroleum Reserve. We held flat in terms of natural gas capture, so good news there, even though it was very cold, and we had constant natural gas production, managed to capture 95% statewide, as well as in the Bakken, and 97% on Fort Berthold Reservation. Still the same four kind of lagging areas: Big Bend, Deepwater Creek Bay, Twin Buttes, and Charleston. All of those should see some construction this summer, and should see some resolution of those issues. When we turn to the federal regulatory front, I want to draw attention to some new activity at the Bureau of Land Management. They announced that they're revising the North Dakota Resource Management Plan, and so the Industrial Commission will be submitting comments on that. Those are due now May 20th. We're very unhappy with the Resource Management Plan and its potential impact on coal mining, critical minerals, rare earth elements, and fluid minerals in particular, which drive the North Dakota economy. On top of that, Bureau of Land Management has proposed a new rule revision that would make conservation, though it's not mentioned in the Federal Land Management Policy Act, would make conservation equal to resource extraction or resource utilization. It would revise the definition of conservation, and it would really elevate it, even to the extent of issuing conservation leases for Bureau of Land Management lands. And so those comments are due June 20th. And of course, the state will be very active in commenting on that. And then just this week, EPA announced its new regulations on carbon pollution, new standards with regards to that. I haven't had a chance to really dive into those in terms of detail. What I think I can say is it's the Clean Power Plan on steroids. And so the Clean Power Plan is back on the table in terms of trying to reduce carbon emissions from coal-fired power plants, as well as from natural gas-fired power plants, and requiring carbon capture and storage. As you know, North Dakota is a leader in that area, but this is a push from the Environmental Protection Agency. As you know, the IRA put a carrot out there in terms of increasing the storage 45Q credits, but now we're seeing the stick come along behind that with these EPA regulations. And I'm sure that the state of North Dakota is going to be very actively resisting these new EPA regulations. So that's it in summary. March was a pretty good month, very cold, less snowfall. I'm anticipating that April will not look so good. As you know, we had major snowstorms in the month of April. And so we had some days when we were really very severely impacted. And so we'll see those March production numbers probably come down as we look at April numbers next month. And with that, be happy to take some questions.
Certainly submit those in, and we can grab Lynn and have them come back on to answer those.
Yes, please do. If you have questions, please submit them in the chat or via email, however you do that. If they come in on the chat, we'll answer them live today. If they come in by email, we'll get you an answer by the, well, not by the end of the week, but within a day or two. Thank you very much.
Good afternoon, everyone. Just get set up here. Justin Kringstad, Director of the North Dakota Pipeline Authority. I've got a pretty basic update here for everyone this afternoon. Not a lot of changes, but you know, one of the things that I'll touch on as we look through production from our neighboring states, Eastern Montana, 1 drilling rig active on that portion of the play. What we have seen in the first part of 2023 is roughly a 20% increase in oil production from Eastern Montana relative to early 2022, and that'll be on slide 3. And as well, the basin as a whole now over 1.2 million barrels per day, so that is higher than any level we've seen over the last 12 to 14 months. So healthy levels of production. When we look at changes in North Dakota alone, as Lynn alluded to, nothing really significant to talk about on there, except for the bottom portion of this graphic, which is that gas oil ratio. And again, seeing a bump up. You know, one thing I've discussed now for a number of months is wanting to take a deeper dive, and I was finally able to get my hands on some data and figure out a way to wrap my head around what was going on and trying to quantify these changes that we've seen. And one of the key things I think that has been driving this, what we're looking at on slide 5 here, is how the drilling activity in North Dakota has shifted over the last several years. And so we've got 3 time periods that are snapped on this graphic. And what you're looking at, the top portion is 2019. The heat map on the left is where the spuds and drilling activity was focused during that time frame. And then mathematically on the right-hand side is what counties were most active during that time period. So in 2019, over a third of all drilling was taking place in McKenzie County, and the counties are color-coded by what their latest gas oil ratios are from those areas. So you can see the highest activity level in the highest GOR portion of the state. And that was really when these wells come on with flush production, they produce high levels of oil and gas right away. And when they're producing even relatively higher amounts of gas to that oil, it's really going to drive that GOR up. And fast forward now to 2022 and 2023, what we've seen is that drilling density and drilling activity move out of what we'd call the core area of McKenzie County. Had roughly a 10-year run where they were the #1 location for drilling activity. We've seen that shift now to Dunn County taking over that position and spreading out a bit more. So you've got Dunn County, Williams County now in 2023 in the #1 and #2 spot year to date. And again, if you look at those colors, Dunn County has a relatively low starting gas oil ratio. So these wells that are coming on with flush production, they're coming out online less gassy. And so that is influencing at least the near term gas oil ratios that we've been seeing. However, fundamentally, even the wells from Dunn County, Williams, and every county you see here, those wells will get gassier over time. And so we're going to continue to see that trend. I think what we've seen and experienced the last 9 months was a blip, not by accident. This is what happens when rigs move around. But fundamentally, over time, we're going to continue to see that gas oil ratio continue to increase, and we should continue to plan accordingly. Even though we've had a bit of a reprieve, seen good gas capture numbers, less gas to oil being produced, but I think this is one of those key drivers behind it. So when we look at crude oil production from the basin, that 1.2 million barrels per day in the region that needs to be moved, we did see crude by pipeline take another small increase in market share. We saw a little less on the rail side when we looked at the March numbers. And what was interesting, and I'll touch on in a moment, was the destinations for that rail movements that was remaining out of the basin. Pricing. When we look around what the various pad area, what the refiners are paying, pad 1, pad 5, highest priced markets, but it was pad 5 of the 70 roughly a unit train a day, 70 to 80,000 barrels per day estimated. The EIA was showing that 100% of that was going to pad 5, which is the West Coast. And so EIA, it's not uncommon for those numbers to get refreshed and relooked at. So this may change, but as of right now, they were showing 100% of North Dakota's crude oil in March going out to the West Coast, which would be a first, that there wasn't some level of mix between those pad destinations. I don't know that that fundamentally is something that we should consider to be sticky, or that would be a permanent situation. There's no reason that those Pad 1 refineries couldn't continue to purchase Bakken crude, but at least for March, that was the estimate. When we look at what pricing is doing as of today, again, weakness all around the board. Brent pricing, the Cushing, the WTI pricing as of this afternoon. And then even a little bit weaker in that Clearbrook market. We're now $1.27 over WTI. Premium is always a great situation. That was something that years ago was almost unthinkable, but seeing that premium continue, it's not in that $3-4 premium that we saw earlier this year, but still at a premium, which is very encouraging for the Bakken producers. Imports, exports, no major shifts on that front. Gas capture, identical again, coming into the month of March, where those challenges are. Very good success, and it was encouraging to see those numbers come from Lynn's report. I'll fast forward to slide 15, which is looking at well connections. We're continuing to see the midstream companies do a very good job keeping pace, getting well connects completed, staying on top of those new wells as they're coming online. The number of well connects going forward, I expect that to continue to stay balanced. The coordination that's happening out there between the producers, those midstream companies, continues to work very well. Lastly, the EIA on their oil price outlook, they did have a small haircut as we moved into May, took a couple dollars off their longer term outlook here, still those mid 60 levels as we exit that 2024 timeframe in their model. On the gas capture side, again at the localized level, gathering processing still in a very strong position, should be well capable of being able to continue to have these very positive gas capture numbers. And when we look at the macro level, moving that natural gas out of the basin, continue to see more and more market share moving on to the Northern Border pipeline system. We've now seen consistently now for a couple of weeks over 80% of Northern Border's flow coming from the Bakken. That's due to a couple things. Obviously, the Bakken production increasing, seen a bit less pressure from the AECO, the Canadian production coming down through that Port of Morgan on Northern Border. So we have had some open space on Northern Border as it exits the region, but that Bakken share continues to uptick. And when we see this, one of the things that I immediately start thinking about when we get 80+% of Northern Border moving Bakken gas was what was happening with the BTUs. The latest data you can see here down in that 1080, 1085 type range. So not pushing the limits in the last several weeks as it relates to that kind of 1100 threshold that we have in our minds. So that tells me one thing, that there's a lot of ethane that's being pulled out of the residue stream and moving down into the Y-grade markets, which is good to capture that value and keep it in the petrochemical side versus the residue burners. So with that will conclude my formal remarks. I'd be glad to answer any questions.
Thanks, Justin.
Thank you.
I think we're going to call Lynn back for one more question.
I was hoping you'd make Justin answer that question. Thank you. Yeah, so I believe the question that came in was, with the low price of natural gas, are we hearing from our oil and gas operators any talk about cutting back on production projections or rig counts? And in fact, as you saw from Justin's, I think maybe the third from last slide or whatever, we've got a lot of excess capacity now built into our gathering and processing systems. So even with the low price of gas, the oil prices are robust enough that companies are actually planning to grow their oil production this year. So there hasn't been any talk of reducing anything as a result of the low price of gas. I'm sure it's going to impact some day-to-day decisions as they have to make a decision about, do I flare a little bit in order to maintain oil production? What do I do? Because the gas is definitely not a profit center at this point, nor are the natural gas liquids. It does make it easier for our 3 operators that are jumping in to produce gas enhanced oil recovery to make those projects work. And so those projects have started now and are up and running. I want to remind you that we have the one in Ross, which is re-injecting produced gas and using foam and what are called nanobubbles. We've got the one that's restarted that uses intermittent gas and now produced water injection. And then we've got the one that is a huff and puff produced gas injector over at Epping in a relatively undeveloped area. So the economics of those look a lot stronger at these gas to oil price ranges, but no impact being picked up at this point with regards to slowing down any kind of activity.
Thanks everyone for joining us. Have a good day.
Thanks all.